That's a narrative with real potential, given the aging population and the growing demand for tech-driven healthcare solutions. Financially, CLIK has shown impressive revenue growth, up 36% year-over-year, and it's actually profitable, with a positive net income and a very attractive P/E ratio of around 4.2. However, the stock has been extremely volatile, surging over 150% on the partnership news and now trading well above its recent averages. For a small-cap company, that kind of price action can be a double-edged sword. It attracts momentum traders, but also increases the risk of sharp pullbacks. If you're an aggressive investor with a taste for growth, and you can stomach the volatility, CLIK could be a speculative buy. Subscribe. Next up is ABP, ABPro Holdings Inc. This one sits firmly in the biotech space, and like many clinical stage biotechs, it's a classic high-risk, high-reward play. ABP is working on some promising cancer therapeutics and has recently secured strategic partnerships and new funding, which is always a good sign in the biotech world. Analysts who cover the stock are actually quite bullish, with a consensus strong buy rating and a price target of $4, significantly higher than where it trades now. But here's the catch: ABP has almost no revenue and is burning through cash, posting large net losses as it develops its pipeline. This is the kind of stock that could either soar on positive clinical news, or crash if trials disappoint or funding dries up. Moving on to Foot Locker Inc. We're looking at a very different animal. Foot Locker is a well-known retailer, and its stock has rebounded sharply from its lows. However, the fundamentals are less compelling. Analysts currently rate it as a hold, and their average price target is actually below the current trading price, which is never a great sign. The valuation is also stretched, with a P/E ratio north of 120, which is extremely high for a retailer, especially one facing headwinds from changing consumer behavior and increased competition. While some value investors might see opportunity here, I'm not convinced. As for GTI, Graphjet Technology, this one is a real wild card. The company has no reported revenue, negative earnings, and a tiny market cap. There's no analyst coverage and no clear catalysts on the horizon. In my view, this is a pure speculative play with little to recommend it from a fundamental standpoint. Finally, there's AYTU, AYTU Biopharma Inc. Unfortunately, there isn't much current data available, but historically, AYTU has been a microcap biotech with a reputation for high volatility and risk. Without updated financials or a clear sense of the company's direction, it's impossible to make a strong case for buying in right now.